Hi everybody, welcome to the Middle Class Investor. This is Seth Martin. Today is Friday, October 3rd, and we had some pretty volatile action in the market this week. Let's just zoom in here and look at the week. This was last week. Last week was down week. This week was a down week, but then recovered. We had gone up and just touched this resistance box and sold off. Sold off through this resistance box. And I've got some new lines drawn here, some of these green lines, and we'll zoom in on those in a minute and look at them. But right now, let's just look at the 5-year weekly charts and talk about them a little bit. So we've got a rising wedge here. We closed outside of it. I'll show you in a second on a daily chart, and I think that's significant. If you look at the VIX is still moving upward, although chopping, which is what the VIX does actually. So we've got this trend line here that we've been watching, and it's still holding. Euro US dollar looks pretty bad for the euro. If we get we've broken through this support box, and I would say if we trade below this next week, then we're probably going to this box. There's still a chance at this point, even though it's closed below the box, could bounce here and make a move higher. But if it trades below here, I think it's going to go all the way down here. It's kind of in a, the euro has had a very large run, and it's unusual without the market taking a breath and going the other direction. So I think the odds of it continuing to here without stopping are probably fairly low. I think the higher odds are that we gap up on the euro and then trade up, maybe into just below this box before it resumes lower. It looks like the euro, though, wants to break out of this consolidation pattern and go lower, down here or even lower. So we'll continue to watch that. I would not be long the euro. In fact, we're going to look at the US dollar here in a minute, and that's where probably I would rather be. So let's look at the interest rate, the 10-year Treasury. We've been talking about this possibly being the low, and this being the first move off the low, and this first correction after the first move. So we're going to continue to watch that closely. I think at this point we can just about say that this looks good for the next move higher. It looks like our little trend line held. It's really hard to say at this point, but it looks like to me this has held up, and this is just a correction of this move. So, we had this move from this location right here up to here, and it looks like we're correcting a little bit, back, and then we'll make a move higher. Now, the next move higher on the 10-year should take us up above this 3.1%, and it'll take several weeks, maybe even a couple of months. So we'll keep looking at that. I would definitely say that if we break above this zone right here around 2.7%, definitely want to be out of your bond funds. If you haven't taken the opportunity to get out of your bond funds during this pullback, and you're just waiting to see what's going to happen, I think if you get above this high right here, you definitely exit the bond funds. Let's see. That's the 10-year Treasury. Let's look at. Let's go back to the S&P 500 and zoom in on this a little bit. Let's look at 6-month chart. And you can see we didn't actually close below this line, which is really, I think I misspoke a minute ago and said we closed below it, but it's just really interesting that the market came down to this level here and then bounced as aggressively upward as it did. That could mean, it's real hard to say, but it could mean that, this is kind of what's called a hammer, and usually it signifies a bottom, and this could be the bottom, and we could be making a move higher to higher highs up here around 2030. But the other thing I did is I zoomed in on like a 20-day chart. And the interesting thing that I noticed here is that, let me see if I can, I'm not sure if all that's in the, can't remember where the, let me see where the, yeah, so right about here is where the screen runs out. So let me see if I can get the majority of this in here. May not be able to see all this. I'm not sure. But one of the things I notice here is that you get this thrust, and then a move back, and then another thrust, and then a move back, and then another thrust down, and then a move back. And it almost looks like to me these thrusts downward are getting longer. Like this one's longer than this. This one was about the same as this one, but then this one was really long. So, I don't know. To me, it looks somewhat bearish. When I see this, this is something I call a megaphone pattern, and not just me. A lot of people call it that. And if this is in fact going to be a megaphone pattern, you could see. Well, if we're looking at it, let's go back to a daily chart and look at like a 6 month. It's very, very plausible for the market to come down here and close at new lows below this low over here. So we'll just look and see what happens there. If Monday we get a little pop, a little pop up, and then immediately sell off, look for this to just sell all the way down into this area. And make a new low. Now, what the market for the year is. Let's see, where was January 1st? January 1st is right here. So 1845 is what the market started the year at. Let's call it about that. So if we get a hard sell-off here on this megaphone, it's going to wipe out most of the gains for the year. But, we might actually just go up here and retest this resistance area. I don't know. I was kind of thinking the other day, wow, this closed below the upward wedge, but looking at it now, it really didn't, which is unusual. I thought for sure we were either going to see, last week we were I don't know, right in here or something like that. So this is Friday, Thursday, Wednesday, Tuesday, Monday. So last Friday we were right here, and I'm thinking, okay, well, this is an inside day. If we get a close above this, it's likely to go up here and make a new high. If we get a close below this, it's likely to go down here and potentially break out of the wedge. Well, we got a close below this low, and it went down, touched the wedge, the bottom trend line of the wedge, opened up the next day, came up, and then sold off really hard. But then today it just completely, like that day didn't even happen, and went back up. And clearly this line is providing some resistance. So I would say if next week we get a close, if the market opens and it closes up above here somewhere, then we're likely to make new highs. If it closes down, outside of this wedge area, then we're likely to make a low and most likely come back and revisit these lows. So I would just look for one of those two things to happen. If you're long your 401k or IRA, it's probably still not quite time to do something. But if we get a solid close below this trend line here, we're probably going to get more selling, probably down into all the way down into the 1750, 1725 area. And then what we'll do is we'll say, okay, the trend has definitely changed. We'll wait for the market to push back up into this area around kind of what the lows were this week, and then look to make a decision. So that's kind of what I see going on here. Of course, if we close above, let me zoom back in. If we close above this high right here, which is almost 1971, if we close above that, then I would look for the market to meander its way back up in here into the 2030 area. Okay, let's go look at gold real quick. This is gold, and of course you can see the high here at 1923.70, kind of meandered its way down, popped back up, sold off hard. It's been consolidating, and now we have, lo and behold, we have a close below this consolidation pattern, and I would look for gold to get down into this $1,000 area. Maybe not quite, maybe 1050 before it bounces. And then when it bounces, it's going to bounce really hard. I mean, if you're going to try to catch a multi-year bottom in gold, you're going to need to step up and buy in this 1050 area, and then look for gold to move into this 1375, 1400 area, have it breathe a little bit, and then go up higher, maybe into this 1650 area. I think we're much closer to the bottom in gold than we are at the top. So I would say gold's got a little bit more selling left in it, maybe to around 1050 or even 1,000, and then look for it to bounce hard up here into this 1375 area. Now, the interesting thing is the dollar is pretty much driving all this. So what's happening in the world is, we've gone through our QE program, so we've devalued our dollar relative to the rest of the world, with the exception of Japan. Japan seems to be even more aggressive about devaluing their currency. But now you got Europe talking about doing their QE program, and other central governments. Around the globe. So now what's happening is money is flowing back into the U.S. and it's causing the dollar to go up. And this is a pretty strong move in the dollar. It looks to me like it's still got some room to go. It might slow down. When it gets up here around the highs, around 89 or so. And then I'd look for a little bit of a pullback, maybe up to 90. Then look for a pullback, and then the dollar will likely resume even higher. I mean, the dollar looks like it's got a lot of room to run to the upside. So, just we'll watch it. One of the things, if you're bullish on the dollar, and I'm not saying you should get in it right this second. Might wait for a pullback, but you could look at the UUP. The UUP goes up. I mean, you can tell that chart looked very similar to the one we were just looking at. You can see that the UUP has been on a tear lately. You might look for the UUP to pull back maybe into this gap around 2210, and then try to catch the next move out, because really buying it right here, it's pretty extended. I mean, you could easily see this pull back to I don't know. You could see this pull back pretty good ways. I mean, I would say, if I can get control of this thing. I know the screen is not 100% there, so I'm not going to use that. But I would say you could easily get this to pull back into maybe a zone somewhere in this zone right here. So, I'd look, if you're going to buy the UUP, I'd look for a pullback into this zone between 21.95 on the low side and 22.30 on the high side. Just pick a spot in there. The other thing, we talked about interest rates going up. This is the 10-year yield. We talk about having this make a move out. And if you're looking to try to trade rising yields, you could look at the TBT. The TBT here showing this first move and then a pullback. Now, the one thing you need to know about the TBT, really, or any of these inverse ETFs, the TBT is an ETF. It stands for Exchange Traded Fund. And the thing you need to be aware of these, they use futures contracts and options and things like that to make these do what they want them to do, and there's some expense involved in them. So what you've got, if you looked at this versus the we could just do that. Let's look at this versus the whoops, that's not what I want. Sorry about that. Let's look at this versus the TNX. So dollar TNX. And what you can see is that in this pullback, it pulled back harder than the TNX did. Well, the TNX is an inverse, okay? So what this is showing is that in order to get this pullback, they did some stuff in the fund that made the fund lose value even faster than the TNX did. Now you can see here in this up move, the TNX is in blue, and the TBT tracked pretty good. In fact, it tracked pretty good until you get right into here. The reason it diverged here a little bit is apparently when it's pulling back, it's harder for them to emulate the TNX. You can see that here. When it pulled back here, it kind of diverged a little bit and then got back on track here. So, theoretically or officially, it's got a 95 basis point expense to it. Right in here, to me, it looks greater than that. Right in here, that looks about right. And then it looks like when it's going up, there's pretty good correlation. So you might try to, I don't know, maybe this isn't the best instrument. You could probably look online and see if there's some other instruments, but if you were doing some short-term trading, this is fine. If you're going to buy it and just hold it, just know that during pullbacks you could lose some ground here, more ground than what the pullback is showing you. The other thing you could do, let me remove this left scale. Remove left scale. Okay. The other thing you could do if you're bearish, when you become bearish, if you're not bearish right now, but when you become bearish, you could also buy something, and I trade this, called the SDS. It's kind of a double short, the S&P 500. So if the S&P 500 is down 1%, this will be up 2%. So if you look at the S&P 500 today, notice this is down 2.17%. If you look at the S&P 500, it was up 1.12%. So the SDS is an inverse of the S&P 500. And you can trade this now. Same kind of thing. Obviously the market's been up, so it makes sense that this has gone down. But this also loses money over time because of the backwardation in futures contracts and things like that. So just be aware that there's an expense to holding this over a long period of time. And even though it'll be going up if the market goes down, over some period of time it won't go up as much as the market went down, just because of this backwardation. They have to use these other instruments in order to derive this curve. Okay, so just be aware of that. It'll talk about expenses on. If you go to the internet and you put up SDS, it'll talk about expense ratio or something like that. So there are no perfect instruments. I mean, you can always short stock or something like that, but it's difficult to do and hold for long periods of time. So that's about it this week. I mean, for those of you that didn't see last time, I talked about some of the underlying things that are causing problems in the market, and really, if some of this starts to unravel, it's going to be a lot worse than the housing market, because the problems are just so much bigger than the housing market problem. We're talking about derivatives on bank leverage, and it's leverage on leverage kind of thing. And when you unwind it, it really disrupts the financial markets in a big way. And you could see some pretty big moves. Here's some little facts here for you. The bank debt is growing 30 times faster than our economy. Well, that can't be good, right? The banking system has over $60 trillion in debt. And you can see, I've talked about this before, but when we went off the gold standard here in 1975, I mean, basically the government became unconstrained, right? And, the banking system and everybody else levered just right along with it, As more and more debt was created, then that's what caused the economy to grow. So we have a debt economy. This talks about the leverage in the Federal Reserve. So this is what the Federal Reserve has in, think of it in assets, capital reserves. So this is how much money they have in their checking account, and this is what they're on the hook for. Think of this as like a debt, how much they owe. Okay, so you can just imagine if you owed this much, but you only had this in assets, that'd be pretty hard to service that debt, and that's what the Federal Reserve has got on its plate. It's amazing how calm these guys look when they're testifying, and gals. You got Janet Yellen now, but Ben Bernanke was he barely even had a pulse. And if this were my money, if I had this much in assets and I had this much debt outstanding, I would be sweating all the time. So we talked about this last time also. This is how much our GDP grew for every dollar of debt that we created. So if we created $1 of debt, it created $2.41 of GDP. In the 70s and 80s, that $1 of debt creation created only 41 cents of GDP. And today, $1 in debt creation is only producing 3 pennies in GDP. So that doesn't sound good. This is the total leverage worldwide in the banking system. So when you have real low yields in treasuries and things like that, the banking system, the banks tend to lever that up using derivatives to boost their returns so that they can return 6, 8, 10%. And of course the derivatives, if the market starts to go against the banks, they're going to have to sell some of these derivatives to raise cash, and then that creates more selling, and then that creates more selling, and you kind of get a kind of vicious circle. This was the stock market cap to GDP. So this is what the capital size of the stock market is relative to GDP. And you can see that here in the dot-com bubble, it was 204. During the housing bubble, we were 183%. Right now, when this chart was created about a month ago, we were at 203%. So we're right there, where the stock market cap to GDP. And obviously, if GDP is overestimated, then this is even worse. So you kind of see some of that going on right now, where they're talking about, you hear people speculating about what the third quarter GDP is going to be, and they're always talking about, it's going to be a 2.5% year because we're going to make it up in the fourth quarter and stuff like that. Well, I mean, I don't know how they know that, but I think it's just a forecast, right? They don't really know. So this is just to call your attention to, we're at the same level of conditions that we were when these peaks occurred, okay? That's all we're saying. And we're back to our banking system debt growing very fast. So anyway, that's it for this week. Guys, I'll leave you there with a picture of the euro. The euro is just getting hammered. I think what this tells me is that the participants in the market think that the European Central Bank is going to be doing some QE like we did. The problem for them is the euro is not the reserve currency. I mean, politically that may be very difficult for them to do. So I don't know, but right now it looks like traders are believing it. If Mario Draghi says he's going to do QE, it looks like to me the traders believe that. So that's what's going on with the euro. The euro is kind of a strange thing too, because it's really not a financial. It's really not about currency so much as it is about politics. You've got countries like Greece and Spain and Italy that run huge deficits and are bad risks for people that might be interested in owning euros. And then you got countries like Germany that are solid countries, right, and are good for it. So it's kind of like it's kind of like here in America, where we have everybody's living at the expense of their neighbor, right? We have all these welfare programs. We got all this stuff. The problem is your neighbor, he thinks he's living at your expense. So everybody thinks everybody's living at somebody else's expense, but they're all in the same boat. So I don't know. I'm not sure how this is going to work out. There's a lot of people speculating that the reserve currency that the dollar enjoys will eventually go away. I don't know if that's going to happen or not. I hope it does. I'd like to see us go back to a gold standard personally, but I don't know. Doesn't seem to be, right now at least, there doesn't seem to be a lot of interest in that. So anyway, that's it for this week for the middle class investor. You guys, follow me on YouTube. Follow me on Twitter. Send links and YouTube links to your friends. And let's, right now looks like we got about anywhere from a half a dozen to a dozen committed viewers, which is not very many. Which means I guess I'm not providing enough value. So maybe when things sell off a little harder in the market, people get a little bit more interested and watch a little closer. We'll just have to see how that goes. Anyway, that's it for this week, guys. Take care, and we'll see you next time. Goodbye.